Hi, everyone. Welcome to Market Outlook, Trends, Risk Events, and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a quick look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll follow the usual format. So we'll just check out how markets are trading currently. We'll then look at review briefly NVIDIA's results, obviously, from last week. Huge market risk event. So we just have a few thoughts on those. Earnings, of course, which had a major impact on markets and will do going forward, obviously. Really interesting price action around that event, actually. And then, in fact, after that, with non-farm payrolls from last week as well. So, we'll look at NVIDIA, of course. We'll look at stock markets across the US as well on the chart side. So we'll look at the S&P, NASDAQ, and the Dow, and just look at how markets finished off on Friday. Well, then, as I said, just touch upon non-farm payrolls. So we'll touch upon last week's main risk events or economic data releases. So, yeah, we had non-farm payroll, of course. We had the FOMC minutes as well, quite important. And then in the UK, we had CPI data. And also PMI data generally across the Euro area and the US actually as well. So we'll look at last week's main events and then get into this week's main events as well. So a little sort of less top tier data, if you like. We do have US retail sales, but they're out from September. We do get the UK budget, which generally normally is fairly not really market moving, but it is this time with everything going on in the UK. So we'll touch upon that. We do have the RBMZ meeting where a rate cut is expected. And we have Tokyo CPI as well. So bits and bobs really to get through. We'll look at all the associated currency pairs as well. So cable, of course, sterling against the dollar, Kiwi dollar, dollar yen, and then euro dollar as well with those PMIs. So various bits to get through. As I said, first up, how markets are shaping up currently, really. I should say as well, please do ask any questions along the way, whatever I'm talking about or looking at, or anything you're looking at in the setups. Please do ask questions. I'm more than happy to answer or try and answer those as we go through the webinar. So markets generally, APAC stocks, they were mostly firmer actually following Wall Street's Friday handover, though China was mixed amid reports of Trump trying to sell NVIDIA chips to China. That has given US futures a bid and really changed the sort of dynamic for this week, actually, where there were still AI bubble questions. Potentially, that is quite a big move by Trump and then for AI hardware stocks and the sector in general. The Fed's Collins, she said she hasn't made up her mind on December, while Treasury Secretary Bessent said prices are getting better, and that's one of his key aims is to get prices down. The dollar, just checking that out, mild selling really, fairly contained. A euro dollar has bounced from 115. Cable's pretty range bound actually. Dollar yen is firmer again, trading at 156.86 now, but it is limited in holiday trade. Treasuries and bonds, that's German government bonds, they're fairly contained after the move seen on Friday. Crude pretty uneventful actually, and gold as well, hovering just above 4,000 at 4,069. We also have some geopolitical news with Ukraine and Russia, that peace deal or not. The US's Rubio said good progress has been made and had been made actually regarding Ukraine, and none of the outstanding issues are insurmountable. That is interesting because you read obviously different reports about that and how Ukraine isn't really very happy at all. And there are reports that Russia and the US had been talking for quite some weeks to concoct that deal. It certainly isn't a deal yet, so that is a sort of obviously a story that is to be continued and ongoing very much with Ukraine and Europe, especially wanting a say in what happens going forward. We just get to Nvidia then first up. And their numbers. I think I had these charts last week actually. So, but just really highlighting how, of course, strong and important Nvidia is. We all know that really. Top 5 trillion. It's now sort of 4.5 trillion, back to 4.4, 4.5 trillion, I think. But the first company to top 5 trillion in market cap, and then its importance and outperformance really over the tech sector even, and then of course over the S&P 500 from the start of this year has been quite something, although more volatile, we should say, and that's what I put in here. Still strong, but still or more volatile this year rather than being a sort of straight line up. I think, really interesting. Obviously, CEO Jensen Huang, he kicked off his presentation by saying there's been a lot of talk about an AI bubble. And from our vantage point, we see something very different. That took all the headlines, really, of course, with all this talk about there being this AI bubble. And he tried to pretty much knock that on the head straight away. It was the 10th quarter in a row that NVIDIA has beaten Wall Street estimates. Just for your guide, they smashed it out of the park, considering or looking at the numbers really. So EPS that increased to $1.30 versus $1.26 or so. That pulled in $57 billion in revenue versus 55.2 expected. And the vast majority, of course, came from data centers, 51.2 from data centers, expected 49.1 billion. And then gross margins climbed to 73.4%. Quite incredible, really. Revenues then, they climbed 62% from last year, and that was expected 55. For the coming quarter, that was probably key as well. So we had a beat on the estimates, and then everybody wanted to see a raise on guidance. So for the coming quarter, NVIDIA expects plus or minus 2%, $65 billion of revenue. That's plus or minus 2%, sorry. And margins between 74 to 75%. And the revenue, sorry, was just above the estimates of $61.6 billion. So as I say, both a beat and a raise, that was kind of the minimum in a way that markets wanted. And markets responded positively after hours, because these results were obviously after hours after the US close. Just looking at some of the comments, CFO Colette Kress said Blackwell chips, the firm's flagship model, are sold out. She said we currently have visibility to $500 billion in Blackwell and Rubin revenue from the start of this year through the end of calendar year 2026. And then both, Huang as well actually said Blackwell sales, and I quote, are off the charts, he said. It's interesting because in the past, Huang has used earnings calls really to discuss promising opportunities for future sales. And he said his chip sales could climb to $50 billion in revenue, depending on trade talks with China. And then Kress actually said their forward guidance does not include any expected data from China, leaving actually some room for kind of another miracle beat somewhere down the line. And especially then this news we've had over the weekend with Trump potentially wanting to sell chips to China really could be hugely impactful to, as I said, the AI hardware sector, and then NVIDIA as well. Short story then, or the summary really, it did after hours really boost lots of other names, the Mag 7 names initially, as well as other AI cloud computing specialists like CoreWeave. They were both, that was up 8%. AMD was up 4%. Broadcom up 4% as well. That was after hours, just to give you a guide of the initial reaction from the report. We said last week, actually, options had seen an implied move around plus or minus 7% after the report. And that would have been the largest market value move for the company ever, according to Reuters. So NVIDIA was up close to 5%, I think, post market, and that gain was more than $300 billion for a 4% move. But then we kind of had this turnaround move. So let's just get the chart now for Nvidia. Let me just grab that 1 second. And you can see that here. So you can see big red candle here on that Thursday. So obviously we had reports on the Wednesday, and then obviously the reaction on Thursday when we opened. You can just see, if I pull up the 1 hour chart, you can just see how we spiked on the open up to 196 and just above 196 on the nose actually, and then from then we just turned lower quite sharply, and it was quite some move, quite a shock really to everyone really, because Nvidia's results were good. Let's not doubt that really. They beat and they raised, so that impressed Wall Street analysts. But then we had this big turnaround through the day. And then on Friday, we had that low just after the open, actually down to 172.93. And then we pulled back to sort of just below 180. So that big turnaround, really interesting. I was trying to find sort of various reasons or trying to look for really concrete reasons as to why that happened. There wasn't really a specific reason for this turnaround happening. I should probably give you some valid ones that I sort of read about, but I struggled really. Potentially, it was simply a big day of liquidity, of course. So funds were using that liquidity after Nvidia's results, really, and the rally just to pare back some of their positioning pre-Thanksgiving, of course, which is this Thursday in the US. So we have a long weekend, really, with markets closed on the Thursday or on the Friday, sorry, but then just a long weekend. So liquidity will be thinner. So really, just some pairing of positioning, really, which has obviously been stretched, as well as expectations, of course, which have been very hot. So if you take as well those two reasons as well, positioning and expectations, then potentially that's why we got this reversal where they have been so stretched that then we have seen a pullback from those. I think obviously as well, we've written about this, but then just the general sort of AI valuation story being still high and elevated. Nvidia's concentration risk with, I think, 60% of their revenues being from 4 of the hyperscalers. We've talked about the circular flywheel and this sort of self financing, refinancing financial loop, if you like. I've called it the AI sort of capital hot potato. So there is still talk around those, as well as then some of this funding that we're seeing by some of the AI names, if you like, not specifically Nvidia, but other AI names are now funding not through free cash flow, but in debt, sorry. And we're seeing more sort of debt issuance by some of these companies. I think it's been around 90 billion since September. We hadn't seen that, or I think it's around 120 billion that we'll see in the whole of 2025. So just recently, we've seen more debt being raised or more finance being raised by debt and not by cash flow. Although, again, this is really only sort of 80-90% even of what is being funded anyway. So just a couple of areas there to note on the chart then. Sorry, that's fundamentally really just some sort of negatives there, but obviously still stressing that the Nvidia earnings were still quite something. We've shown you the turnaround then. And if we just pull this chart back actually now, just on the technical side. Let me pull it back. Because we're in the hourly, that's why. So bear with me 1 second, sorry. Right, there we go. Sorry. Right, that's better. So daily chart there. So you can just see the 50-day moving average at 186.46. That's the blue line. Then we do have that low from Friday. That's a 172.93, as I said. And we're kind of just back to this minor fib level of the Liberation Day to recent record high rally. So the minor 23.6 retrace level, that's a 182.56. And we're just hanging around there, which is an interesting sort of support resistance level. Below that, then we've got a major fib level, 38.2. That's down at 164.22. And then the record highs in NVIDIA, 212.19, you can see there. Okay, that's Nvidia. Otherwise, stocks generally last week, well, yeah, were volatile, of course, with that turnaround on the Thursday, and then just some buying on Friday, really, which was interesting, really. And again, we had rate cut bets on from the Fed actually picking up quite substantially on the back of comments from Fed's Williams. He's one of the sort of troika of leadership in the Fed, and he has been known as slightly hawkish, and he sort of tempered his remarks really, and sort of offered hope about a December rate cut. And that really turned Fed rate cut bets, as I say, on its head from sort of 30-40% or so to sort of now near 70%. That's for a December 25 basis point rate cut. Otherwise, yeah, equity stabilized on Friday with the S&P up close to 1% higher. Interestingly, small caps, Russell 2000, that gained a full 3%. And European stocks as well, they edged higher. Interesting, it wasn't sort of was not a rebound led by the most sold names really, so that's interesting. We think instead markets saw kind of a selective rotation with investors refraining kind of from buying the dip in the most heavily sold AI names, or in Bitcoin, of course, for that matter, because that was down 2% on Friday, despite being, well, down over 20% actually in the last month. So it was small caps and sectors such as materials, healthcare, consumer discretionary that fared the best on Friday. So interesting, not those beaten up AI names really. And similarly, actually, the rebound spread or did not spread, sorry, to the AI hardware region. So in Asia this morning, the same story as well. Although, as I said, US futures, European equities are doing slightly better. Yeah, I was just checking European equities there actually. So it's kind of a selective rebound actually, which is important to point out, we think, and especially after last week's sell-off was unusual. So not in magnitude really, but really in the fact that the drawdown in equities was not synchronized actually with other asset classes. We pointed this out actually in our weekly commentary, where the move index, so where we've got the VIX, which is the Wall Street's volatility gauge, if you like, and that is a gauge on S&P 500 options to 30 days out. That's basically the VIX, but it's known as Wall Street's fear gauge, and that obviously popped higher last week. And if we just pull up that chart, actually, because we haven't seen it for a while, but you can just see how volatility picked up here, just up to sort of 26 or so. So we saw volatility in stocks, as we've said, but in the move index, which is kind of the equivalent, bond market equivalent of the VIX, so gauging volatility in the bond market, that was pretty stable. So we haven't seen this sort of sell-off volatility in stocks going into other markets. Same with FX, fairly quiet, even though we saw a dollar bid, of course, last week, but generally not massive moves in FX compared to these moves in on the volatility really in stocks. And of course, we've seen the S&P off around 4 or 5% from its highs, yields moving, copper prices, gold, and credit spreads actually little change. So interesting that we think, and worth highlighting. And it's probably a sign that the November sell-off is probably not macro driven nor liquidity related. And as such, the fundamental read across to equities outside the AI theme, uh, such as European markets, actually should be fairly limited. We say that, but obviously we don't know going forward. But that's just one observation we thought was important to point out. So just looking at equities, you can see the VIX, and we've just come off that 26 high actually. Long-term average in the VIX around 17, 18, just for your guide. So anytime we pop up above 20, then you do see we have seen volatility in obviously equity markets for sure. If we just look at stocks generally, then just quickly, so the SP 500 here. Interesting, as I said, a couple of circuit breakers, I think somebody called them on Friday, which have impacted. So first of all, we did get those comments from John Williams, actually, is the New York Fed president. As I say, one of the leadership sort of members in the Fed, relatively dovish remarks, and certainly against the recent comments by Powell. And then, as I've said, again, we had reports surface that the Trump administration considering allowing NVIDIA to sell its advanced H200 chip to China. So, yes, we've just seen the VIX come down. We've also seen Fed rate cut bets go up and sort of double from actually down at 30% last week to sort of 60% and above now. So as for the S&P 500, you can see the bid in futures here. Actually, if I pull up the futures chart, we're up around 1/3% actually. And then on the cash chart, just using that, you've got the 50-day moving average, the blue line, which has been decent support. So that could be resistance. And it was resistance. You can see on Thursday, that's a 67.11. Otherwise, if we do get back above that, then we're into this. It could be a false break, really, potentially, and we're back in this ascending bull channel with the record high at 69.20. Otherwise, important low from Thursday at 65.34, and you've got sort of minor fib level at 64.79. Nasdaq, similar chart, of course, 50-day moving average just below 25,000. And then you've got a minor fib level at 24,000, just above that, 24,054, the 38.2 of this move from those May lows up to the record highs, and the record high at 26,182. For the Dow, similar chart again, although futures marginally higher, just a 4 pips higher after the 1% move higher on Friday. So the 50-day moving average, the blue line again, that's at 46,655. Then we've got a minor fib level of actually the rally from the April lows up to the record high at 48,431. So a minor fib level of that move, that's at 45,641, as I said. And then below that, we've got the 200-day moving average and the 38.2 retrace level of 43,916 and 43,894. So around 40, just below 44,000, but that is some way below with that near-term support at 45,641. Okay, let's move on now just to last week's main events, apart from NVIDIA, of course. So first up is non-farm payrolls, of course. And if you just bear with me, I've got a graphic with the main numbers actually, which are here. Hopefully you can see that. Yep. It's just a graphic with the main numbers from that report. So obviously stressing that it is the September non-farm payrolls report, so it is stale. Yes, something to bear in mind, but it obviously gives us a guide of sorts to where the employment picture is heading. And then stressing, of course, we get the October data without unemployment data, and then the November data not till the middle of December. Can't stress this enough. That's meant to be released on December 16, October and November non-farm payrolls. That is after the Fed meeting, which is on December the 10th. So very important that to stress, because obviously policymakers at the FOMC will be still fairly blind going into that meeting. And that is something to bear in mind, of course, as they try and make a decision on rate cut bets or rate cuts, sorry, I should say. For this report, though, excuse me. Headline was 119,000. That was against consensus estimate of 51,000. So a decent headline number for sure. August, though, was revised down to negative 4,000 actually from plus 22,000. And we saw a total of 33,000 downward revisions to August and July. The unemployment rate, despite the stronger headline rate, that increased to 4.4% from 4.3%. And that was driven by actually a rise in the native US-born labor force and a decline in immigrant workers. That picture's been going on for a few months now. Just for your guide, then, I've put in there the Fed's projection is for a 4.5% jobless rate by the end of this year. Again, I want to stress it's a 7-week delay to this data. So again, the usefulness of it for assessing current conditions is somewhat mixed, I'd say. Just in the detail, interesting sectors strong before the shutdown have stayed strong. So that is sort of healthcare and hospitality, restaurants and government. Those three sectors, they make up nearly 90% of job gains. They have done for the last couple of years. I have said this on numerous occasions, and they're not really the sectors that you want or would hope that or would boost the economy long term in growth. They're not the sectors. Manufacturing, for example, that would be far more favorable if jobs were being created out of manufacturing. But those three sectors, they've again provided virtually a lot of the vast majority of job gains in the US, again in this report as well. I should say, for the averages on that headline, just for your guide, the economy's now added an average of 76,000 jobs per month. That's the average this year. That is roughly in line with updated estimates of job creation needed to keep pace with population growth. But the caveat to that is, as immigration and job gains continue to fall, then the break-even number, if you like, will be harder to calculate. And that is a big issue for economists at the moment. Much debate around the pace of growth to keep the labor market in balance. And an increase kind of in unemployment suggests the recent pace is declining a bit short. So, that's just on the NFP report. I should say the first half monthly pace of job gains was 83,000, then 76,000 for the whole of this year. And just for your guide, 2024's average monthly pace was actually 168,000. So you can just see that decline in the average monthly job gains. 3-month pace now on 462,000. And you can just see here, actually, after the report, as I said now, that's a stale number, but it was worth putting in after report, just around a 1 in 3 chance only of a Fed rate cut bet. And those odds turned on its head, really, by John Williams' comments, as we mentioned. That's pretty much it for non-farm payrolls. We did see, muted reaction, really. Small dovish market reaction, slightly. Those odds, as I said, have moved, and we are seeing some dollar selling now. So that was MNFP. Also in the US, we had the Fed minutes, as I touched upon, from the Fed's October meeting. And they really highlighted continued divisions among policymakers regarding rate cuts. While most participants expect further cuts over time, many suggested it would be appropriate, to keep the target range unchanged for the rest of the year. That kind of echoes recent hawkish comments from the Fed Schmidt, Kashkari, Hamak, and Logan, and who have all said actually they would have preferred to maintain rates unchanged already at the previous meeting. Interesting that, and that's sort of why we had that 1 in 3 bet really after those meeting minutes, and then after NFP as well. As I say, pretty much changed around a lot since then. If we just look at, let's quickly look at the dollar chart. So this is a DXY chart. Let me just pull that up. So you can see that here. Interesting where we are now. So we're just at these highs from sort of late July, early August, and then early November as well. The black line's a 200-day moving average. That's a 99.85. We're just above that, but whether this is a big pivot point along with those highs previously, sort of around, where are we, 125 or so from that high in the start of August and then the start of November, as I say. So interesting area here. Looks just potentially, if we hold this sort of upward trend line, then this is just bullish consolidation before push higher. But yeah, 200-day moving average at 99.85. That could be a pivot level as well. And we've still got in here this long-term low from July 2023, I think it is, at 99.57 below. And then you've got that upward trend line, short-term upward trend line you can see there, which also is around 99.57 as well. So a few levels there to consider for the dollar here this week, going into retail sales that we'll look at shortly, and general sort of risk sentiment. Okay, let's move on quickly to UK CPI data. That came out last week as well. Had this chart last week, but still good to keep in there. Inflation in the UK looks to have passed its peak, essentially, and that's helped by a smaller rise in household energy bills than last year. But the drop in the headline from 3.8 to 3.6% was a touch smaller than expected, 3.5% expected, I think, because food prices unexpectedly picked up. And core as well stayed at 3.4%. That said, encouragingly, actually, if you look at Eurozone data and UK producer price data, that suggests supermarket inflation is probably close to topping out, actually. And then that means the Bank of England's year-end food forecast may actually prove too high. For now, though, the food rebound sort of keeps the Bank of England hawks worried that inflation expectations could drift higher again. Crucially, services inflation, though, that dipped from 4.7% to 4.5%. That reinforces the idea, really, that the September soft data was kind of an anomaly, though this was mainly due to actually cheaper airfares. Core services, if we get into it, that's the metric the Bank of England, the MPC, watches closely. Actually, that ticked up slightly, with restaurants and cafes showing firmer price pressures. And if you live in the UK, you would vouch to that, I'm sure. Still, wage growth, importantly, that is cooling still, and services inflation is trending lower overall. Likely keeps the Bank of England fairly split, and that means then Governor Bailey may lean towards the doves. He'll have probably the deciding vote in December, and if he leans towards the doves, that makes then a December rate cut still the most likely outcome. Markets very convinced, really, that there will be a 25 basis point rate cut, around 70-80% chance of that, I think, now. But of course, we get the budget this week as well to consider, and we'll touch upon that shortly. So if we look at cable quickly, here's the chart of UK CPI. Apologies, just for your guide. Just bear with me 1 second. Yeah, apologies about that. I still had the screen on the DXY. Hopefully now you can see that UK CPI chart. So yeah, here we have the UK CPI chart here. Apologies for that. So yes, this was the chart before we got the release. So obviously core stayed at 3.6%, but the headline, the red number, that moved down from 3.8 to 3.6% as well. And then services was 4.7, and that moved down to 4.5%, just for your guide. If I just pull up cable, just bear with me 1 sec. Yeah, sorry, cables here. So sterling against the dollar, of course. Interesting. Yeah, we've sort of found some support just above 130, really. You probably got a downward trend line there, tapping that spike high from the middle of September and also then that high in October. Let's just draw that on actually. So roughly from here to roughly around there. So that could be resistance, which tallies with that 38.2 fib level of this year's rally, essentially. That's at 131.40. I've been stressing that in the daily commentary we put out, actually. You can see there the August low around there. And with just that downward trend line as well comes in, yeah, around that level as well. 131.40, then interesting. Otherwise, then you've got a very short term swing high there at 132.15. And then interesting, you've got the blue line, which is potentially moving down through the black line. So that is the 50-day moving down through the 200-day, which is, if you don't know, of course, is a death cross. So fairly bearish. Sometimes that is quite a lagging indicator, though. So just be careful of that. But that is interesting with those levels just around sort of the 133 mark. So as I say, initial support probably 130, just above there, and then you've got the halfway point of this year's rally at 129.41 in cable. Otherwise, we had PMIs. So just let's pull up euro dollar. Out on Friday, actually, November PMIs for the Eurozone, they were close to expectations. Actually, the composite falling marginally to 52.4 from 52.5. Consensus was 52.5, so nothing there really. Manufacturing did decline, though, below 50 to 49.7, and expected was 50.1, actually. While services climbed actually better than expected, 53.1, expected was 52.8. Prices, the indices, they showed an uptick actually in input prices and a marginal decline in output prices. That kind of means inflation remains under control, really, and the risk has shifted probably from inflation being too high now to instead being too low. And with growth holding up, then, well, the ECB on hold at 2% throughout, well, the next few months, if not the next half year at least. And that's despite inflation forecasted to fall below the 2% target. For euro dollar, then you can see, yeah, we're just sort of finding support around this minor fib level of this year's rally. That's at 115.07. Then the top side cap 16.30. 7, and then we've got below there the black line at 114.09, which is the 200-day moving average. And then just above that, we do have these swing lows from July around sort of 113.91. Okay, let's move on then quickly to this week's main events. So we have retail sales out of the US. We have the budget and the RBNZ as well. So here's retail sales charts. You can just see the headline number is the orange number, and then the blue line is core retail sales. Will be important data really because it gives us an insight, of course, into the US consumer and consumer spending. Remember that makes up more than 2/3 of US economic activity. Um, I should caveat that by just saying these are, again, the September figures, so slightly stale again, but markets will be watching them for sure. Consensus then, expectation for the headline 0.4% and for core at 0.3%. That's from, well, the headline prior at 0.6, so touch lower, and the core will stay, the core stays the same, I think, at 0.3. And then we also have the control group that's predicted to be at 0.3%, previously 0.7. Interesting because really there's been more focus on this sort of divergent groupings of lower and higher income groups, and a sort of tale of two consumers, if you like, with high income groups certainly benefiting from wealth effects from obviously rising stock markets, but then lower income groups much less so. It's also Black Friday week, of course. That heralds the start of the important holiday shopping season. Black Friday, the day after Thanksgiving, that ushers in holiday sales, and it kind of arrives as data has shown consumer sentiment really slumping now, and inflation staying relatively firm. So interesting point for these retail sales, even though they are stale. Okay, moving on from that to the budget then. This is just a chart showing, yes, the precarious state of UK public finances, really. This is a debt to GDP ratio, 95%, really. So levels last seen in the 1960s, believe it or not. The budget then, after all, sort of all this speculation, gossip, U-turns, non-U-turns, we finally get Chancellor Reeves giving this budget on when is it? Sorry, it's on Wednesday, the 26th. Essentially, it is down to the fiscal hole, the fiscal issues that the UK has at the moment. And that fiscal hole that needs to be filled is roughly 25 to 30 billion pounds. So essentially, Chancellor Reeves, she must raise tens of billions of pounds in taxes to stay on track for her self-imposed fiscal rules. Markets, as I say, not generally concerned with a UK budget, but in this instance, they are because of the numbers involved and because of, as I say, those fiscal rules, which the Chancellor doesn't want to break, even though, of course, in the weeks before this, we had a U-turn and then a U-turn with Chancellor Reeves potentially at that time going to break one of the manifesto pledges of the Labour Party, which was then, of course, reversed. All the focus is on UK government bond markets. That's the gilt market. And we did see a recent sell-off in that, which kind of serves as a sort of chilling reminder, if you like, that certainly deteriorating public finances are a market theme, and that is not only in the UK but globally, of course. And that sort of wider picture about the US fiscal situation as well, which only rears its head when it kind of needs to. But certainly in the UK, that is also an issue. And if we just think back then, the government's U-turn, as I said, on raising income taxes, really that set things in motion. So the positive connotation, if you like, to not having to raise taxes again and break the election manifesto, as I just mentioned, after gently preparing for that hard message over the previous few weeks, that kind of pales compared with the feeling that Labour had lost control over the fiscal narrative. And that is the issue, of course, with the Labour Party generally, historically known as that. but this chancellor really wanting to be quite firm that she wouldn't break her fiscal rules. The lack of visibility for UK households, of course, and businesses, and the lack of vision really from the ruling party has been an issue, though, over this period, of course, increased uncertainty and question marks about the ability of the government to get finances back on track. That's kind of in a nutshell, hopefully, a sort of summarize the situation that we see ourselves in the UK anyway at the moment. Markets have whipsawed really. After then that U-turn, which Bloomberg reported basically was due to more favorable economic projections by the Office for Budget Responsibility, which then triggered apparently the government's change of heart that they wouldn't have to raise taxes, income taxes, sorry. And that the budget gap actually was to be around 20 billion rather than the long feared 35 billion. And that's without restoring existing fiscal buffers. That's where I get my sort of 25, 30 billion. 20 billion is the gap. And then headroom is needed, of course, with eventualities going forward, which need to be accounted for by the Chancellor. So she leaves, as I say, some headroom, hopefully. So where are we now? Yes, essentially, there will be a sort of smorgasbord, if you like, a whole collection of smaller increases in different taxes that the Chancellor will announce because of this smaller gap to fill. There'll be, yes, a mixed bag of small non-structural measures, if you like, rather than that bigger one-time income tax increase. There is a lot of politics to this, of course, and kind of highlights the fragility of, in a way, the PM Starmer and Chancellor Reeve leadership with then a sort of internal revolt building. Markets may be concerned about that, but probably not on Wednesday. But going forward, of course, if there is a loss of concern by the MPs in the Labour Party, then potentially that is something to be careful of. If you remember when there was speculation that Reeves would step down, then markets convulsed slightly and gilt yields went quite sharply higher. The alternative, of course, to Chancellor Reeves would be very likely somebody more left wing and paying less attention to fiscal rules potentially, which then the markets fear and gilt yields will go up and really not support the pound. That is the key point, sorry, that I probably want to get across. And really, yes, we'll be watching gilt yields, the 10-year gilt yield around 4.7%. If it goes much higher above that, then that would be an issue as markets are concerned, and that would hit this pound with the pound going lower. We've looked at the cable chart. I think I'll just briefly touch on, just quickly, I know I've been going on here, and I do appreciate you being here. If we look at euro sterling, this is an interesting chart, probably more so than euro dollar, which is obviously, sterling against the dollar, because it obviously has the greenback involved, whereas euro sterling as well against the euro. And you can just see that break that we had above 87 there, break high, and we're just sort of spiked higher to that multi-year high, actually 88.65 there, you can just see, and we're just sort of hovering around that. You've got the blue line, the 50-day moving average capped the downside, so that's at 87.41. So just watch out for euro sterling as we go into the budget on Wednesday. Okay, finally, we'll just catch up on, sorry, again, I've done it, apologies. And I think the question is, yes, here is sterling against the dollar. Yes, let me just go over that again. I think I did already. Yeah, I did already, but let's go over that again for you. No problem at all, Nina. Yeah, so you can just see I drew that downward trend line which is at that major fib level of this year's rally that you can see. That major fib level of 38.2, the dotted line there is at 131.40, and that tallies with the downward trend line. So could be an area of resistance above that. You've got then the 200-day moving average at 132.97, the black line, and then the blue line is the 50-day moving average at 133.08. And if you remember, I said potentially that 50-day crosses down below the 200-day, which is a bearish signal for many, a death cross, and potentially warns of lower prices going forward. Below, then you've got the swing lows from early in this month at 130.10, and then you've got the halfway point of this year's rally at 129.41. Okay, otherwise, just quickly, Kiwi dollar, as we do have the RBNZ, a bearish channel really in the Kiwi, you can see there. And we just dipped to multi-month lows, actually, lows not seen since Liberation Day, really, around April. Those lows at, where are they? 55.81 or so. So if we lose that, then we've got the lows from April actually at 54.84. So bearish move in a Kiwi dollar. Just on the RBNZ, then money markets do expect a 25 basis point cut, which takes the OCR to 2.25%. Just briefly, a data dependent stance really is likely in the new year, as we have had recent mixed